Okay. Good morning, all of you. Yesterday we completed section 46A. If you remember, section 46A. It was on buyback, right? So if a domestic company is there doing a buyback of shares from the shareholder, shares can be any type of shares. Yes or no? So this buyback means extinguishment of right, which is a transfer as per section 247. On this buyback, the buyback price will be given to the shareholder. So in the hands of domestic company, 115 QA was applicable. The company was liable to pay tax on this buyback price. Accordingly, this buyback price was exempt in the hands of shareholder. Hence 46A, the capital gain on buyback was not applicable in this case, but this used to happen till 30th September 2024. But with effect from 1st October 2024, the provisions have been amended, and here now section 115 QA is not applicable, meaning it is withdrawn, and the domestic company is not liable to pay tax on such buyback price. Accordingly, the exemption which was available to the shareholder under section 1034A is also no more available. Accordingly, the buyback price will be taxable in the hands of shareholder, but it will not be taxable as your full value of consideration under the head capital gain, but it will be treated as deemed dividend under section 222F without allowing any deduction under the head IFOS. Now, capital gain will also be calculated under section 46A, and to calculate that capital gain, full value of consideration should be taken as nil, and deduction for cost of acquisition shall be allowed, which will result into capital loss, either the short-term loss or long-term loss. Yes or no? Now, if that same domestic company is buying securities except shares from any security holder, in this case, there is an extinguishment of right, meaning transfer of those securities by the security holder to the domestic company for which the buyback price is given. That buyback price will be treated as what? Full value of consideration to calculate capital gain under section 46A. Based on that buyback price, the capital gain will be calculated by the security holder, and the security holder will be liable to pay tax on that capital gain. Yes or no? Okay. Now, if any company is there other than domestic company, if that company is doing the buyback of any shares or securities from the shareholder or security holder, this is also extinguishment of right. This is also a transfer, and if any buyback price is given by the company to the shareholder or security holder, based on this buyback price also, the capital gain will be calculated under section 46A. This will be treated as full value of consideration to compute the capital gains. Yes or no? Everyone? We discussed this entire section yesterday. Okay, no? 46A is over. Now today we are going to start with special aspects. Capital gain, how to compute capital gain in special situations. Okay. Now the first section here is section 50. Which section? Now section 50 talks about how will you calculate capital gain on transfer of depreciable assets forming part of block of assets of a business or profession. This section I have already explained while doing the PGBP head. If you remember, a small table like this I had already explained in PGBP some 10-15 lakhs years ago when dinosaurs were alive. That time I explained this, if you remember. Okay, that time you were very small. Asset should be there in the block, value should be there in the block, only then you can calculate depreciation. If assets are there but value is not there, entire value is recovered by transferring few assets in the block, then value of the block does not remain, so nothing can be allowed as depreciation. Whatever excess amount recovered over and above that value is known as what? Short-term capital gain. Yes or no? But if no assets are remaining in the block, meaning all the assets of the block are sold, but the amount recovered on selling the assets, transferring the assets from the block, that amount recovered is less than the value of the block, then still some value will remain in the block. But to allow this value in the form of depreciation, there are no assets in the block at the end of the year. So even this value cannot be allowed as depreciation. Then whatever value remains will be treated as short-term capital loss. And if assets are not there, value is also not there. All the assets are sold, and they are sold for a amount which is more than the value of the block. Then entire value of the block is gone, and the amount recovered over and above that value will be treated as short-term capital gain. These two cases known as block does not cease to exist. These two cases known as block ceases to exist. There are some assets in the block. Value is there, value is not there. Yes or no? If value is still there, claim depreciation because there are assets in the block. Yes or no? But if there is no value remaining in the block, that means no depreciation. The amount which we were supposed to allow you in the form of depreciation is no more remaining in the block. Then whatever excess amount is coming, that will be short-term capital gain. Yes or no? If there are no assets in the block, meaning block ceases to exist, meaning all the assets in the block are transferred. At the end of the year, there are no assets in the block. So value may remain, value may not remain. If the value still remains, then this value cannot be allowed in the form of depreciation because against this there are no assets. Yes or no? Then this will become your loss, short-term capital loss. And if no value remaining in the block, meaning all the assets are transferred and the value entirely recovered, any excess recovery over and above the value of the block will be treated as short-term capital gain. Few examples, 4 cases I explained, case 1, case 2, case 3 and case 4, if you remember. 4 cases also I had discussed with numbers in the PGBP head. So this is already done. Now you have to remember that, see, whenever you are talking about assets, so section 50 says how to determine capital gain on transfer of what? Capital assets. And these are the capital assets which are not held as it is. These are the capital assets which are there in the business, in the block. So any capital assets which are forming part of what? Forming part of block of assets in your business or profession. So the capital assets are there. Capital assets. See, do you remember the definition of capital asset? Tell me, what is the definition of capital asset? What I am asking, bloody, what answer you are giving? I am asking what is the definition of capital asset? You are talking capital gains. Any bullshit you will talk. Capital asset definition. Asset or property of any kind, whether tangible, intangible, movable, immovable, fixed, circulating, whether used for business or not. So even if the assets which are used in the business are your capital asset only, but their cost is not allowed under capital gain head. Their cost is allowed under the head PGBP, from business income. Few assets which are of same type, having same rate of depreciation, are in the block. So its entire cost will form part of the value of the block. Yes or no? And that amount, that value of the block, which is nothing but the total cost of all the assets which are there in the block, that is allowed as a depreciation under PGBP head. Now if you are holding those assets, if you are holding those capital assets, but you are holding those capital assets as a part of block of assets in the PGBP head, in your business or profession. So whenever you transfer those assets, definitely if the assets are there in the block and those assets are transferred, sold, scrapped, damaged or destroyed, compulsory acquisition, whatever way, those assets can go now. So those assets are going from the business, no? Because these assets are there in the business, in the block, and whenever they will be transferred from the business, from the block only. So it will be deletion. It will be deletion. And at the time of reducing that deletion, the net amount meaning full value of consideration minus transfer expense, the net amount which you receive on deletion, you reduce from the value of the block itself. So how did you calculate the value of the block? Tell me. Opening WDV of the block. What is this opening WDV? This is the remaining cost of those assets in the block as on the first day, which you acquired earlier. So the cost on this asset was acquired, the cost of these assets was incurred in earlier year. Out of that cost, some cost was already allowed in the form of depreciation. This is the remaining cost of those assets which are still there in the block in the beginning of the year. So opening WDV is nothing but remaining cost of those assets which are there in the block in the beginning of the year. Out of the actual cost, some cost is already allowed in earlier years in the form of depreciation. This is the remaining cost of those assets which are already there in the block in the beginning. Now few new assets are brought in this same block. So actual cost of those assets will be added here. So this is the remaining cost of acquisition. Add what? Add additions. Additions means greater than equal to 180 days, less than 180 days, not used at all. Yes or no? So whatever assets you are acquiring, the actual cost of those assets will be added to this cost. Can I say this is the total cost of acquisition? Total cost of acquisition. And out of this, you reduce what? Deletion. What is this deletion? Whenever the assets of the block will be transferred, sold, damaged, destroyed, scrapped, compulsory acquisition, whenever the assets will go from the business, they are going out of the block. They are going out of the, at that time what will happen? The full value of consideration which you are going to receive, the amount which you are going to receive minus transfer expense, yes or no? So this net amount you reduce from here. This net amount which you reduce from here is nothing but full value of consideration minus transfer expense. So ultimately you are calculating the capital gain only. Instead of writing full value of consideration minus transfer expense, net consideration, out of that net consideration you reduce cost now. So instead of writing like this, full value of consideration, transfer expense, cost of acquisition, what you are writing? You have shifted the cost of acquisition above. What is the format to calculate the capital gain? Tell me. You take full value of consideration minus transfer expense. You will get net consideration. Out of this net consideration, you reduce cost of acquisition and you reduce cost of. Simple, no? If I take this thing above and I take this thing below, this is the same format. Instead of writing cost of acquisition here, I am writing cost of acquisition before. Instead of writing full value of consideration minus transfer expense above, I am writing it below in the form of what? Depreciation. Sorry, in the form of deletion. Calculation of capital gain only is happening. See, whenever you determine the value of the block. But if the asset remains in the block and the value also remain in the block, this value we will allow in the form of depreciation. But if this cost is higher than the recovery, if this cost is higher than the, still some amount will remain. That amount will be treated as your short-term capital loss if there are no asset remaining in the block. Understanding? So 4 lakh plus 2 lakhs. 4 lakh plus total value of the block. So total cost of the block 6 lakh. and you are selling few assets. Are you selling all the assets in the block? No. You are selling few assets and you are recovering 7 lakh rupees. So by selling few assets only, you are recovering 7 lakh, meaning you are recovering the full value of the block, and still 1 lakh rupees extra recovery is happening. That is your short-term capital gain. We have done all these things, yes or no? So this opening WDV and addition is nothing but the cost of acquisition. And this deletion, whatever amount you are reducing, is nothing but full value of consideration minus transfer expense. This is you reducing as this amount you are reducing as deletion. So ultimately, if the asset remains, what did I say? If the assets still remain in the block and the value is still remaining, what is this? You calculate and claim depreciation. If the assets are remaining but no value in the block remaining, then short-term capital loss. Few assets you sell for a value higher than the value of the block, entire value is gone. Excess recovery is happening. That excess recovery will be loss, no? Short-term capital gain. This is given under section 50. If there are no asset remaining in the block, no asset remaining in the, value may remain and value might also become nil. So if value still remains, this will be treated as your short-term capital loss under section 50. And if no value remains and excess recovery is there, that will be your short-term capital gain under section 50. Now remember, whenever the gain will arise, the gain will always be short-term. Whenever the gain or loss will arise, that will always be short-term. Because you don't check period of holding of those assets which are there in the block. Why you don't check the period of holding? Because the moment the asset is added in the block, its identity, its individuality is lost. Now you don't recognize that asset. Now it has become the part of the block. Identity of the asset is gone. So no need to check any period of holding of the assets which are being transferred from the block. Yes or no? So period of holding you are going to ignore. Period of holding of those assets you are going to ignore. And if you cannot check the period of holding, there is no point of classifying those assets as long-term assets. You can classify those assets as long-term only if the period of holding is more than 24 months. Yes or no? So if you are not going to check the period of holding only, there is no point that you can say that the assets are long-term. So the assets can never be classified as long-term. All the assets in the block, period of holding you are supposed to ignore. Because you are not supposed to check the period of holding of each assets in the block. The moment the assets are, put in the block, its identity is gone. Their identity is gone. So forget about their period of holding. And if you forget about the period of holding, they cannot become long-term. And whatever gain or loss, whatever may be arising, yes or no, will always be treated as short-term. Will always be treated as short-term and will be taxable at what rate? Normal rates. Will be taxable at normal rates. And the short-term loss will be there. That short-term loss can be allowed as a set-off against short-term gain as well as long-term gains. Done? Yes or no? This will be your section number 5050. So this is a special case where how to calculate your capital gain. So to calculate that capital gain, consider the opening WDV plus addition as the total cost. Yes or no? And consider the amount of deletion as your net consideration. Full value of consideration minus transfer expense will become the net consideration, nothing but the deletion. And compare these two figures, you will automatically get what? Loss or gain. If the value does not remain, excess recovery is there, it is a gain. If the value still remain, it will be loss. But it will be a loss only if there are no assets in the block. If the assets are still there, value is still there, there will be no short-term gain, no short-term loss. You are going to be there in the PGBP head claiming the depreciation. Understood? So, will you take any period of holding of individual asset? So, no individuality or identity of the assets in the block. That is, the moment the asset becomes the part of the block, its identity is lost. Therefore, period of holding of each assets become irrelevant and must be ignored. Further, period of holding of the entire block also cannot be determined, because the block is not single asset. Block is the group of many assets together. So you cannot determine the period of holding of the block also. So period of holding itself will be ignored. And any gain or loss arising on transfer of assets from the block is therefore treated as short-term gain or loss. Benefit of indexation is completely ignored. Even if few assets in the block are transferred by holding for more than 24 months, you are not going to give any indexation. Indexation is also not allowed when you calculate the capital gain under section 5050, because the capital gain cannot be long term. You are calculating which capital gain? Short term, and to calculate short term gain you never give any indexation. Yes or no? So earlier when indexation was allowed for all assets except section 5050. It was an exception to indexation. Yes or no? Will you remember? Section 5050 done. Then come to section 50A. This also you know. Read the heading and read this entire part. Come on, tell me. Read this part and tell me something like this you know or not. What did you understand from this? Tell me something like this I have already explained or not. Where? Do you remember one example I took? This case is for transfer of which asset? On which depreciation is claimed under section 3211 on what type of assessees? Assessees in power business. Yes or no? Those assessees are supposed to calculate and claim depreciation on individual asset. So they are not supposed to form blocks. They are not supposed to form block of asset. They are supposed to calculate depreciation on each asset. Now each asset identification is there. Identity is not lost because block is not formed. Will you form the block? No. You will take each asset separately. Yes or no? And on that each asset, actual cost of each asset, on that actual cost you will apply prescribed rate of depreciation. By applying this rate, whatever depreciation will come, that depreciation will be allowed on what basis? SLM basis. That is a normal depreciation given under section 3211. Do you remember you bought one asset, asset X, for 100 lakhs for this business in the year 2020-21. You claim depreciation in 2021, 22-23, sorry 21-22, 22-23. Out of 100 lakhs, 40 lakhs depreciation you have already claimed earlier. 60 lakh cost of that asset still remaining as what? WDV. Now if that asset is transferred in this year, meaning you are transferring a capital asset only. You are transferring a capital asset only. But that capital asset is in your business, and on which you are claiming depreciation under section 3211. On what basis? So will there be any capital gain on that asset? No, first there will be terminal depreciation or balancing charge. All the adjustment will be done in the PGBP head. But yes, if any recovery is there over and above the actual cost of that asset, recovery over and above WDV, recovery over and above WDV, but less than actual cost will be adjusted in the PGBP head only in the form of balancing charge. You are not supposed to bring that under the head capital gain. But any recovery over and above the actual cost will result into capital gain. And we took 4 cases also. WDV was 60 lakhs. But the amount on sale was only 45 lakhs or only 42 lakhs. Remembering? So the selling price recovered is less than WDV and less than actual cost also. Forget about actual cost. If it is less than WDV, it has to be less than actual cost only. Yes or no? And whatever balance remains, 60 lakhs minus 42 lakhs, 18 lakhs will be treated as your terminal depreciation. Do you remember that? What if the assets are sold for 60 lakhs? So amount recovered is equal to WDV. No effect has to be given. No effect under PGBP, no effect under capital gains. And then what if the amount was 75 lakhs? More than WDV, but it is still less than actual cost. What you did? The excess amount which you receive over and above WDV, but to the extent of depreciation allowed earlier, yes or no, will be treated as balancing charge. So how much excess amount you recovered? 15 lakhs by selling the asset for 75 lakhs and whose cost was whose WDV was 60. So over and above WDV you are recovering 15 lakhs. That 15 lakhs we are going to treat as your balancing charge only. Under the head PGBP, it will be treated as your deemed PGBP income. Because we consider that this amount of 15 lakh you have recovered out of the depreciation which we have allowed earlier, which was 40 lakhs. So out of 40 lakh, 15 lakh recovered. So this 15 lakh will be treated as deemed PGBP income, balancing charge. But what if you sell that asset for 105 lakhs? Have you recovered 45 lakhs more over and above the WDV? What was the WDV? 60 lakhs. You have sold it for 105 lakhs. So how much excess recovery? 45 lakhs. Any excess recovery to the extent of depreciation. Depreciation allowed was 40. So recovery of 45 to the extent of 40 will be treated as your deemed PGBP income, balancing charge. What about the 5 lakh extra recovery? Will be taxable here in capital gain. So for that 50A says that any capital gain on transfer of depreciable asset on which depreciation is claimed under section 32(1)(1) on what basis? If such capital asset is transferred, capital gain to be computed and charged to tax under this head only when the sale consideration is more than the WDV as well as the actual cost of such asset. And example, the same example I took there also. See, 4 cases. You remember? These 4 cases. 1, 2, 3. First case, terminal depreciation. Second case, no effect. Third case, balancing charge. Yes or no? And the fourth case, balancing charge is there up to depreciation which is allowed. Yes or no? And over and above that, whatever excess is there, that is 5 lakhs. Taxable under the head. In other words, actual cost of that asset, which was fully disallowed under PGBP head now. So now 60 lakhs will not be allowed as a depreciation. And earlier also the 40 lakh which was allowed is now treated as deemed PGBP income. Entire 100 lakh cost of that asset. Now that actual cost of the asset you are going to bring under the head capital gain. So out of the selling price of 105, reduce this actual cost to calculate your capital gain. So selling price minus what? Actual cost, which was 100, will result into 5 lakh rupees of gain. And this gain can be short term also, this gain can be long term also. Now you are going to see the period of holding also of this asset. Why are you going to see the period of holding? Because the asset is not there in the block. Asset is held individually. And if you hold the asset individually, you will see the period of holding. If the period of holding is more than 24 months, long term, so the resulting gain will be long term. If the period of holding is less than or equal to 24 months, asset is short term and the gain will be short term. Yes or no? This was your 50A. Now come to 50AA. Important section. You can expect one question from this section. Three types of assets. Read the names. Now, how will you calculate the capital gain in the case of these assets? See, in the section 50, which asset was there? Depreciable assets forming part of block. In section 50A, which asset was there? Again a depreciable asset, but not forming part of block. Individual asset on which you are claiming depreciation on SLM basis under the PGBP head. Yes or no? Now this third section is there, 50AA. In this section 1, 2 and 3. Three types of assets are given. How many assets? First asset is market linked debentures. Second asset is units of any mutual fund or specified mutual funds which were acquired by the assessee on or after 1st April 2023. See, if the units of specified mutual fund were acquired prior to 1st April 2023, no, then those units will not be covered here. Which units will be covered? Units of specified mutual fund which is acquired on or after 1st April 2023. And you will cover unlisted bonds and debentures also which are transferred on or after 23rd July 2024. So this one extra asset is also included with effect from last year on or after 23rd July. So I am talking about which asset? Tell me. Three assets. First one, market linked debentures. Okay. Second asset is units of specified mutual funds. And these units are acquired. These units are acquired on or after 1st of April 2023. Third asset is unlisted bonds or debentures. Now this unlisted bonds or debentures, if you transfer them on or after 23rd July 2024. When did you acquire these unlisted bonds or debentures? Anytime. When did you acquire them? Anytime. You have acquired them at any time, but your transfer is on or after 23rd July. Yes or no? And what about these units? You are transferring them at any time, but remember, you have acquired them on or after 1st April. And market linked debentures, whenever acquired, whenever transferred. Yes or no? Now any of these three assets, any of these, how you will calculate the capital gains? So section 50AA says that to calculate the capital gain of these assets, always ignore their period of holding. Always ignore their period of holding will not be checked. That means we don't want to consider these assets as long term. We don't want to consider these assets as long term. So we will tell you to ignore period of holding. The moment you will ignore the period of holding, the question of classifying them as long term asset will go. There is no question of classifying them as long term assets. So they will always be treated as your short term asset, and any gain arising on the transfer will be short term gain and will be taxable at normal rates. 50AA is done. So 50AA talks about Three assets. First one, market linked debentures. Second one, units of specified mutual fund. Third one, unlisted bonds or debentures. Okay, no problem. If you transfer these assets, then the capital gain will arise. But that capital gain will always be short term. Will always be. Because whenever you transfer, you are supposed to ignore their period of holding. So you are going to check the period of holding for all the assets in order to determine whether the asset is a short term or a long term. Whether the resulting gain is short term gain or a long term gain. For all assets you are supposed to do. But for these three assets, don't check the period of holding only. They cannot be classified as long term. They will always be treated as short term, and the gain arising will be short term gain. How will you calculate the capital gain? Simple. Full value of consideration minus transfer expense, net consideration, whatever cost will be there. That cost will be reduced. The resulting gain will always be short term. Will be taxable at what rates? Normal rates. Understanding? Now, why this Colaveri D? Why this 50 AA? And what is the logic for doing this? Okay. So first of all, see, if you talk about debt, debt means bonds, debentures, yes or no? For example, I have taken a loan from you. Bonds means what? Debentures means what? If I am issuing bonds, I am issuing debenture, meaning I have taken a loan from you. Hello? So if I take a loan from you, if I take a loan from you, and for that loan, if I am issuing bonds or debenture. Bonds or debentures are nothing but debt. It is a security representing what? Debt. Debt owed by me to others. And others are owing this debt to, others have given that debt to me. So for example, you are a person, you have given a loan to me, you have given some money to me, that is a loan given by you to me. Yes or no? Now tell me, will inflation affect your loan? Because of the inflation, over the number of years, the value of the loan will go up or it will remain same. Simple, no? Inflation does not have any impact on loan. So 10 lakh worth of loan given right now will be worth 10 lakh only after 10 years also, after 50 years also. Getting my point? Because the inflation does not affect the value of the loan given. It will always affect the cost or the value of other assets. So if the inflation is not going to give any impact to the value of the loan, so whether this loan is held for long term or short term, what difference will it make? It will not make any difference. So hence what used to happen, when there was indexation, so indexation was not allowed in the case of short term assets, but it was allowed in the case of long term assets, but it was not allowed in the case of bonds or debentures. In the case of, even if the bonds or debentures are long term assets. Even if the bonds or debentures are long term assets. So remember one thing, even if the bonds or debentures are held for long term period, there is no indexation available. Why? Because indexation is a benefit because of which the cost of asset increases, meaning we include the inflation in the value, in the cost, and we bring the cost to today's level by including what? Inflation in it. And that is nothing but indexation. And knowing that the value of this loan, value of this bonds or debenture, which is a loan only, is not going to be affected by what? Inflation. Giving indexation benefit for them is not a wise thing to do. Its cost will remain same, constant, hence no indexation is available. So any bonds, what did I say? Any bonds or any debentures, okay, other than capital indexed bonds, or sovereign gold bonds. Okay. So if capital index bonds are there or sovereign gold bonds are there, if they were what? If they were short-term capital asset, then there was no indexation. Okay. But if they were held as long-term capital asset, there was indexation available for these two bonds. Only these two bonds. Which bonds? Capital index bonds and sovereign gold bonds. But any other bonds or debentures, whether they are held as short-term capital asset or long-term capital asset, in both the cases, indexation was not available. But the short-term gain will be taxable at normal rates and long-term gain will be taxable at 112 rates. Yes or no? Understanding? So this was the case. Any bonds or any debentures you are having. Any bonds or any debentures other than capital index bonds. And sovereign gold bonds. On those bonds, whether the bonds are held as short-term asset or long-term asset, indexation benefit was not available. So this was another exception to indexation. Understanding? But the resulting gain will be taxable at normal rates if the gain are short-term, and if the gain is long-term, the resulting gain will be taxable at 112 rates. Right? But for capital index bonds and sovereign gold bonds, if they were short-term asset, you are not getting any indexation. Yes or no? And the resulting gain was taxable at what rate? Normal rates. Yes or no? And if they were long-term asset, you also used to get indexation and the gain was taxable at the rate 112. Now all bonds, all debentures, the treatment was like this only. What they did? Last year in 2023, Finance Act 2023, they brought one new section, 50AA. Which section? And in that 50AA, they introduced two assets. First one, market linked debentures, and second one, units of specified mutual fund. Now what is this specified mutual fund? See, any mutual fund which is a debt oriented mutual fund. Which? Debt oriented mutual fund. Unit of that mutual fund. See, equity oriented mutual funds are also there. So I am not talking about equity oriented mutual fund. I am talking about debt oriented mutual fund. They are specified mutual fund. Now earlier 50AA was introduced by way of Finance Act 2023 amendment, and this section 50AA was having two assets. Number one, market linked debentures and units of specified mutual fund, meaning debt oriented mutual fund. Now for these two assets, they said that indexation benefit will not be available. The asset cannot be long term. Ignore their period of holding. Okay. Because we want to charge the entire gain as short-term gain at what rate? Normal rate. So if you will not consider their period of holding, they cannot be classified as long-term asset, and the tax rate applicable on long-term gain under section 112 cannot be applied here, because the gain can never be long-term in case of these assets from now. So what will be the gain? It will always be short-term. It will always be short-term and will be taxable at what rate? Normal rate. Now why it was done? The reason was very simple. That see, if you have 10 lakh rupees, if you have how much? 10 lakh rupees. If you invest that 10 lakh rupees in FD, FD means fixed deposit. Okay. On fixed deposit, will you get interest? That interest will be taxable at what rates? normal rates. Under the head IFOs, that interest will be taxable. So interest on fixed deposit you are getting, for example, 10 lakh rupees of FD you have kept in a bank. On that FD you are getting interest. That interest is taxable as your IFOs income. At what rate? Normal rates. Understanding? You have this 10 lakh rupees. And you now know that on this 10 lakh, if I invest that amount, if I invest that 10 lakh rupees in bank FDs, that is going to give me interest. And sir, that interest will be taxable under the head IFOs, and that interest will be taxable at normal rates, which can go up to 30%. So the assessees who are using huge amount of money, yes or no, which they wanted to keep in banks, in FDs, they thought that if we'll keep this huge amount of money in the bank and we'll earn interest on fixed deposit, that interest is going to be taxed at what rates? Normal rates. So what these type of assessees started doing, they started investing in what? That same money in market linked debentures and the units of these type of mutual funds. Now what used to happen in the case of these assets, the companies did not give you interest. So you are not getting interest. You are not getting interest as a regular income. So definitely you are not getting interest. Nothing will be taxable under the head IFOs. At what rate? Normal rates. Now the interest which you were supposed to get used to be given at the time of maturity. Used to be given at the time of as a higher maturity value. So for example, if you are holding an FD for 2 years, so 2 years you are going to get interest. So FD of 10 lakh, and for 2 years you are going to get what? Interest of, say, for example, 1 lakh rupees. So that entire 1 lakh used to be taxed at what rate? Normal rates. On that the government was getting tax at normal rates, and which could go up to 30% also. Yes or no? Now what the high net worth individuals and what the rich people started doing? No, I will not invest this 10 lakh in FD. I will not earn interest on FD 1 lakh rupees, on which I have to pay what? I have to pay normal rate of tax. Instead of investing this 10 lakh in FD, I will invest in market linked debentures. I will invest in units of specified mutual fund. And I will tell that company not to give me interest, but at the time of maturity, my 10 lakh which they are giving me, give me along with 1 lakh rupees extra. So maturity amount will be how much? 11 lakhs. So that 1 lakh which I was supposed to receive as normal income, taxable at normal rates, will now be received in the form of capital gain, and which can be classified as short term. Then it will be taxable at normal rate. But if I hold them for a little longer period, they will be classified as long term gain, and which will be taxable at a concessional rate of maximum 20%. Because at that time the long term gain rate was 20%. But now that same long term rate is 12.5%. Understanding? So imagine that the amount of income which was supposed to come to you was supposed to be taxed at normal rates. And normal rates can go up to 30%. And that same amount of income you are going to take in the form of capital gains by investing in these type of debentures and units. So amount you are investing there, you are telling them, those companies, those mutual funds or those companies who are issuing these securities or units, they are telling you that, see, we are not going to give you interest, but whatever interest we were supposed to give you, we will give you in the form of maturity amount. So accordingly, higher maturity you are going to get. And what was the cost? For example, 10 lakh you invested, 10 lakh was the cost. Yes or no? And higher maturity how much? 11 lakh. So that 1 lakh which was supposed to be taxed as your normal income at normal rate will now be taxable as your capital gain. And if you will hold it for a little bit longer time, it will become your long term gain and will be taxable at long term rates. And here you are going to save good amount of tax. For example, 1 crore you are investing in these bonds. How much? Cost of 1 crore you are investing. On that 1 crore, for example, 10% interest is also there. How much? Calculate. It will be 10 lakh rupees. On that 10 lakh rupees, the government would have got tax at normal rates. Yes or no? But now, instead of investing that 1 crore, you are investing in these market linked debentures. You are investing in these units. 1 crore entirely invested here. Now, at the time of maturity, how much you are going to get? Regular interest you are not going to get. You are going to get 1 crore 10 lakhs. That extra 10 lakh will now come to you in the form of capital gain. And for your kind information, if you hold them for a little longer period, no, then they will become long-term assets, and the resulting gain of 10 lakh will now be classified as your long-term gain, and on that you can apply only the rates which are applicable for long-term gain, and which is now what? 12.5%. Earlier it was only 20%. Still it was lower than 30%. Yes or no? Entire gain taxable at maximum 20%. But that could have been taxed at 30% also. If it would have been more than 10 lakhs. So any amount in excess of 10 lakh would have been taxed at 30%. That amount was also taxed under capital gain as your capital gain income, long-term gain income only at 20%. Now that rate has also reduced to 12.5%. Just imagine if every high net worth individual start doing this, government is going to lose a lot of tax. Yes or no? So what they said, come here. Why you are investing so much amount in these type of bonds or debentures, we know. So from now onwards, we will ignore the period of holding. So the moment we will ignore the period of holding, they cannot be classified as long term. And we will consider these assets as your short term assets only, and any gain arising will be always treated as short term gain, taxable at what rates? Normal rates. Earlier also it was supposed to be taxed at normal rates. If you would have received the interest income on that, it would have been taxed at normal rates. Then why not now? Understanding? Sure, sir. So, market linked debentures are those debentures on which when you invest in these debentures, no, the returns are not fixed. Just like normal debenture. If you invest in normal debentures, normal bonds, you get what? A fixed rate of interest. And that interest you get on a regular basis. But on market linked debenture, there is no fixed rate of interest. And that interest is not given on a regular basis. Their returns are not fixed only. Their returns depend on some other security, some other market index. So some other security, some other market index is giving you a return of 15%. No. So this market linked debenture will also give you 15% return. If that security, if that other index is giving you a return of 20%, this will also give you 20%. So its returns are linked to any other security or any other index in the market. If that security, other index is giving a return of 10%, 15%, 20%, whatever rate, that much return you are going to get from this market linked debenture, and that return you are not going to get in regular way in the form of interest. That entire return will be given to you at the time of maturity, which will be taxable in the form of capital gain and not your regular income. Getting my point? So people having huge money which they used to keep in bank deposits, earning what? Regular income, normal income, taxable at normal rates, those people started putting their money here. And that same normal income which they used to earn from their normal investments, that same income they started getting, huge amount of incomes they started getting in the form of what? Capital gains. And if they were holding it for a little longer time, no, it used to get long-term gain and it was taxable at flat rates. 30% was never applied only. So government was losing some tax over here. That's why section 50 double. Ultimately the underlying security is what? Debt only. Underlying security is debt. And debt, the value of the debt never increases. It remains constant. So whatever excess amount you are going to get from this now is nothing but your interest. Is in the nature of interest. You should have got it in the form of regular income, but you are getting it in the form of capital gain. So no problem, we are going to charge it under the head capital gain only, but not in the form of long term. Now their period of holding will be ignored. You are not going to check any period of holding for market linked debentures. Understanding? And period of holding ignored, and whatever gain you are going to calculate here will always be short term. Taxable at what rates? Normal rates. Yes or no? Now there is one more, units of specified mutual fund. In these units also the same thing used to be happen. Now what is a specified mutual fund? A debt oriented mutual fund is a specified mutual fund. See, there are two types of mutual funds. Okay, one is equity oriented, another one is debt oriented. Now for example, you are an investor. So you all will give your money to the mutual fund. Hello, investors, are you giving your money to the mutual fund? Now out of the total money, investable amount which the mutual fund is getting, 65% or more is invested in equity shares of domestic companies. Then the mutual fund is equity oriented. So where the mutual fund is investing? Mutual fund is investing in equity. In equity. Out of the total money which the mutual fund collects, yes or no, 65% or more is invested in equity shares of domestic company. So this mutual fund is a equity oriented mutual fund. Out of the total money which the mutual fund receives, 65% or more is invested in debt. Then mutual fund is a debt oriented mutual fund. So if you invest in any mutual fund, you are an investor, yes or no? If you are an investor, you are giving your money to mutual fund, just like you, many other small investors will be there, yes or no? These investors will give the money to the mutual fund. Out of the total money which the mutual fund is getting, mutual fund is investing greater than or equal to 65% in debt securities. In debt securities. So this mutual fund is debt oriented mutual fund, meaning not more than 35%. What did I say? Not more than 35% is invested in equity. Meaning the investment in equity will be 35% or less. Majority of investment, meaning 65% or more, will be in debt. So this mutual fund is debt oriented. So whatever money which the mutual fund collects from the investors, yes or no, 65% or more of that investable amount is invested in debt securities. So this mutual fund will be debt oriented mutual fund. Now that debt oriented mutual fund will issue units against your investment. So the amount which you will invest, against that the mutual fund will issue units to you. So these units are units of a mutual fund which is a debt oriented mutual fund. So now tell me, your units are deriving value from debt only, no? Your units are deriving value. Whatever will be the value of your units which the mutual fund will issue, those units are deriving their value from debt only, no? So your units are also as good as debt which you have given to someone. Now instead of giving this debt directly to some other person, yes or no, you are giving that money to the mutual fund, and mutual fund is giving that amount as a debt to someone. So ultimately your units are deriving value from debt. Now what used to happen? People were not investing here. Some people were investing here. high net worth individual having crores of rupees. Okay, no? So keeping that crores of rupees in the bank and earning normal income, which is taxable at what rate? Normal rates. People used to invest in units, these type of units. Crores of rupees they are investing in debt-oriented mutual fund units. I know that I want to keep my money safe. So definitely I'll keep that money in the bank in any FD. But my money will be safe if I invested in market-linked debentures also. And I can invest that money in the units of debt-oriented mutual fund. Now what will happen if I invest 5 crores rupees in these units? So as an investor, I have given 5 crore rupees to a mutual fund. And ultimately, my money is going to go to any company as a debt only, but through mutual fund. So my units are deriving value. My units are deriving value from debt. Now tell me, on these units, will I get any regular income? No. I just have to hold these units for some longer period of time, and on these units, whatever amount I am going to get at the time of maturity. So 5 crores I am investing right now, and some extra amount I will get. For example, I am getting 30 lakh rupees as a return for holding these units for 3 years. So 5 crores I have invested. After 3 years I will get 30 lakh extra. 5 crore, 30 lakhs. That 30 lakh will be treated as my capital gain. But bloody, if I would have invested that 5 crores in any bank and I would have earned that interest, that amount as interest, that would have been taxed at what rates? Normal rates. But now it is not getting taxed at normal rates because the holding period is a little longer. It becomes what? Long term, and the gain is taxable at long term rates, which cannot go to 30%. It remains maximum 20% at that time. But now it is 12.5% only. Understanding? So what the government did? Government said no. Earlier, whatever units you have purchased, that is okay. But from now onwards, meaning on or after 1st April 2023, even if you acquire these type of units, period of holding of these units will also be ignored. We don't want to consider these units as your long-term asset. And if you will consider them as long-term asset, the gain will be taxable at long-term rates, which cannot go up to 30%. And we want to charge the gain at normal rates. We want to charge this income at normal rates, because this income anyways you are supposed to get in the form of interest, but instead of getting that as interest, you are getting in the form of gain. So no problem, take this income in the form of gain, but we will charge this gain under the head capital gains in the form of short-term gain only at the rate of normal rates. Understanding? And from last year onwards, on or after 23rd July 2024, even the unlisted bonds and debentures are also covered here. Even the unlisted bonds or debentures are also covered here. Now, any unlisted bond, any unlisted debenture, whenever you have acquired, yes or no? But if they are transferred on or after 23rd July, so their period of holding will also be ignored, and any gain arising on those bonds or debentures will also now be taxable at normal rates as your short-term capital gain only. Their gain can also not be taxable as long-term gain, because many companies had started doing this. Many companies started a practice of giving the interest in the form of higher maturity values on unlisted bonds or debentures. So many companies who are issuing what? Bonds or debentures, their bonds or debentures are not listed in the market. Okay. So you go and invest in that company, give the loan to that company and take the bonds or debentures which are unlisted. Okay. That company will tell you that we are not going to pay you interest. Interest very small amount, very small amount. Okay. But see, whatever interest we were supposed to give you, will give you in the form of maturity. So that way, you are getting the regular income in the form of maturity, meaning in the form of capital gain, is also taxable at what? Long-term rates. Because here also you used to check the period of holding, 36 months. If you hold them for 36 months or more, they will become what? Long-term. And their gain was also taxed at long-term rates. So here also the same thing will happen now. Their period of holding will be ignored. And they will be always short-term, and their gain will also be short-term gain, taxable at what rates? Normal rates. Understood? This was your section 50 AA. But remember one thing. Now let's, consolidate everything. See. How many assets are there? Come on, tell me. 50 AA. 3 assets are there. Please remember these names. Very, very, very important. Okay. Number 1, market linked debentures. Number 2, units of specified mutual fund which is acquired on or after 1st April 2023. And number 3, unlisted bonds or debentures which are transferred. Here the word used is, and here the word used is acquired on or after 1st April 23, and the unlisted bonds or debentures are acquired at any time. We don't care. Whenever you have acquired them. But are you transferring them on or after 23rd July 2024? Yes. Then any gain which will be arising will always be taxable as short-term gain. 50 AA has overriding effect in spite of anything contained under section 242A, which defines short-term capital asset, that is, ignore the period of holding of such capital asset. Okay, they will be treated as short-term if their period of holding is this much, 12 months or less, 24 months or less. Yes or no? All those things were given in the definition of short-term capital asset about the period of holding. Yes or no? Anything given in the definition of short-term capital asset regarding the period of holding, section 50 AA has overriding effect over those provisions. Meaning there will be no importance given to the period of holding. Ignore the period of holding of such capital asset. Capital gain arising on transfer of above 3 assets shall be treated as short-term gain, taxable at normal rates. And computation of capital gain, full value of consideration minus transfer expense, you will get net consideration minus cost of acquisition, you will get short-term gain. And question of giving indexation benefit here does not arise only, because it is given in the case of long-term asset. Yes or no? And these assets can never be classified as long-term now. Already told you. Yes or no? So the gain will be short-term gain. This gain cannot be long-term gain since period of holding to be ignored, and hence such capital asset cannot be treated as long-term capital asset. Okay. Now see, whenever you will calculate this capital gain, that time also no deduction for STT will be allowed, because STT deduction is not allowed while calculating the capital gains. So to calculate this capital gain also, if some STT is paid, because market linked debentures are usually what? Listed. So when you will buy them or sell them through recognized stock exchange, yes or no, you will have to pay STT also. Sometimes the units of specified mutual fund are also listed. So when you will buy them or sell them through recognized stock exchange, you will have to pay what? STT. So that STT will not be allowed as a deduction while calculating this capital gain also. Yes or no? Next one. What is market linked debentures? I have already explained. And what is units of specified mutual fund? I have already explained. Go through this. What is market linked debentures? The market linked debentures, underlying principal component is what? Debt only. Ultimately it is a debt only. Okay. And returns are linked to market returns on other underlying securities or indices. So the return on these market linked debentures are not predefined, that you will get only this much return. No. We will give a reference to any other security. We will give reference to any other index. So see, what is the NSE return? Example, the return of National Stock Exchange. Okay, Nifty returns is 22%, no? So based on that Nifty return, the return will be given. BSE, Sensex, yes or no? What is the Sensex return? Example, the Sensex return is 20%. So 20% return will be given here. Whatever will be the return of that index, that return will be given on these debentures. But that return will not be given regularly in the form of interest, that return is given at once, at the time of their maturity. Understanding? For example, any other security is there, any other bonds, any other securities, like government bonds are there. Okay, government bonds are there. Government bonds are giving you interest at 11%. So sometimes that bonds are having different return. Okay, sometimes that bonds or securities are having different returns. So whatever returns which are there for other security, that much return we are going to give you. But that return will not be given on a regular basis. That will be given at one time, at the time of giving you the money back. Understanding? That is what? Market linked debentures. Second one, units of, first of all, what is a equity oriented mutual fund? Mutual fund taking money from the investors, issuing units. So you give the money, you will get the units. But the money taken from you, 65% or more is invested in equity market, equity capital of domestic companies. Yes or no? Then the mutual fund is equity oriented. But what if 35% or less is invested in equity? Meaning 65% or more is invested in debt. Then this mutual fund is a specified mutual fund, debt oriented mutual fund. Yes or no? So any mutual fund where 35% or less of the total proceeds is invested in equity shares of domestic. How much is the investment? Total proceeds which the mutual fund is getting, out of that total proceeds, how much? 35% or less is invested in, meaning 65% or more is invested in debt. Sure, no? Then that mutual fund is a debt oriented mutual fund, specified mutual fund. Understood? Now see, the bonds and debentures, one chart I have formed. Okay, this will give you a complete idea. First of all, any bonds or debentures, any bonds or which are unlisted, which are, now you have to check if they are transferred prior to 23rd July. Because see, if unlisted bonds or debentures are transferred on or after 23rd July 24, can you see here? 50AA says that any unlisted bonds or debentures are transferred on or after. So now they are covered by section 50AA. Will you see the period of holding? No. Ignore the period of holding. The gain will always be short term and will be taxable at what rates? Normal rates. But prior to this, if they were transferred, then you used to check the period of holding also. Period of holding 36 months. How much? So if the unlisted bonds or debentures transferred, if they were transferred prior to 23rd July 24, then their period of holding, if it was 36 months or less, they were treated as what? Yes or no? And the resulting gain was taxable at normal rates, as short-term gain. Yes or no? But if they were transferred, if their period of holding was more than 36 months, they were treated as, although you never got indexation on them, but the resulting gain was taxable at long-term rates, which was only 20%, and now it is only 12.5%. So now what they are telling, that if these unlisted bonds or debentures, earlier whatever you used to do, forget about that. Now, if you transfer them on or after 23rd July 2024, yes or no, then they will be covered by 50AA. Now the period of holding which you used to check earlier, no, you are supposed to ignore that period of holding. That capital asset can never be treated as a long-term capital asset, and the resulting gain can never be treated as long-term gain now. The gain will always be treated as short-term gain and will be taxable at normal rates, because now these assets are also covered by section 50AA. Understanding? What about the listed bonds or debentures? So there are capital index bonds and sovereign gold bonds. They were listed only. They were listed. So whenever you buy any capital index bonds or whenever you buy any sovereign gold bonds, yes or no? So these were listed. These were listed on the stock exchange. So when you buy and when you sell, when you transfer them, capital gain will arise. And that capital gain will be short term if their period of holding was up to 12 months, because they were listed securities. They are what? Listed securities, being capital index bonds or sovereign gold bond. And if they are transferred, prior to 23rd July 24, so you used to check the period of holding of 12 months. 12 months or less, short term. The gain was taxable at normal rates. But if they were transferred after holding period of more than 12 months, they used to be long term. And for these bonds or debentures, you used to get indexation also. So index gain, and the gain was also taxable at 112 rates. So which bonds I am talking about? Listed bonds or debenture. All listed bonds or debentures? No. Out of listed bonds or debentures, only capital index bonds and sovereign gold bonds. If they were transferred prior to 23rd July 2024, what was the situation at that time? You used to check the period of holding. How much? 12 months. Why 12 months, sir? Because they were listed securities, no? So for listed securities, 12 months. 12 months or less, short term. The resulting gain is a short term gain, was taxable at normal rates. What if their period of holding was more than 12 months? They were long term, and see, you don't get any indexation for any bonds or debenture, but you were getting indexation for these bonds or debentures also. Understanding? After taking the indexation, you used to calculate your long-term gain, and on that long-term gain, you used to pay tax at the rate of 20% earlier. Yes or no? Under section 112. But what if these sovereign gold bonds or capital index bonds are transferred on or after 23rd July 2024? Will they also be covered under section 50AA? No. In 50AA, A, B and C, did you see capital index bonds or debentures over here? Meaning that for them, you will still check the period of holding. You will still check the, how much? 12 months. So if they are transferred on or after 23rd July 2024, you are going to still check the period of holding. Period of holding, 12 months or less. They will be short term, and the resulting gain will be taxable at normal rates. Yes or no? But what if their period of holding was more than 12 months? They will be long term. Now you are not going to get any indexation, because indexation is not available if the asset is transferred on or after 23rd July. So if they are transferred on or after 23rd July and the period of holding was more than 12 months, the asset is a long-term asset. Gain will be long-term gain, taxable at LTCG rate 112. Yes or no? But there will be no indexation available anymore. Yes or no? So pay attention. See, if they are transferred on or after 23rd July 2024, period of holding less than equal to 12 months, short-term asset, capital gain taxable at normal rates. Yes or no? And what if they transferred on or after 23rd July 24 and the period of holding was more than, they are still long-term capital asset. Yes or no? But earlier you used to get the indexation. Now indexation is not available because the asset is transferred on or after 23rd July 2024. But the resulting gain will still be taxable under section 112 as long-term gain. Understanding? Understanding? So now tell me, listed bonds or debentures other than capital index bonds or debenture. Any other bonds or debenture, if they are listed, they will not be covered by 50AA. They will not be covered by 50AA. So for them, earlier you used to check the period of holding of 12 months. Now also you are going to check 12 months. So whether you transfer them prior to or on or after 23rd July 2024 will not make any difference. Earlier also you used to check 12 months. Now also you check 12 months. 12 months or less, short term. Resulting gain will be taxable at normal rates. And more than 12 months, long term. Earlier also you were not getting any indexation. Now also you are not going to get any indexation. Yes or no? And the gain will be taxable at 112 rates. Will you remember this? This entire table, no, which I have made chart, is very important for you. So now see that same chart. You are going to help me. I will break that chart into three small parts. Okay, four small parts. First of all, tell me, we are talking about unlisted. What? For unlisted bonds or debentures. Come on. First of all, I am talking about what? Unlisted. Right now, unlisted bonds or debentures. If they were transferred prior to 23rd July 2024. What you used to see? You used to check their period of holding. How much period of holding you used to check earlier? 36 months. So if their period of holding less than equal to 36 months, they are short-term capital asset and the gain was short-term capital gain taxable at normal rates. And if their period of holding was more than 36 months, they were your long-term capital asset and their gain was taxable as long-term capital gain at 112 rates. Okay, no? Long-term capital gain under section 112. Done, sir? Now, if the same unlisted bonds or debentures are transferred on or after 23rd July 2000, now they will be covered by 50AA. What are you going to do? Ignore period of holding. Always short-term capital asset resulting into short-term capital gain, which will be taxable at normal rates. Easy, difficult? Sure. If you will see this type of asset, will you be able to do it like this? Sure, no? Next one. Next. Now I am talking about listed bonds or debenture. And specifically which bonds or debentures? Capital indexed bonds or sovereign gold bonds. Okay, no? Other listed bonds we are going to do third part. But right now we are talking about which listed bonds or debentures? Capital index bonds and sovereign gold bonds. Only these two bonds. Okay, no? Now, if they are transferred prior to 23rd July 2024, what you used to check? If their period of holding was less than or equal to 12 months, they are short-term capital asset, and short-term capital asset means indexation was not available and the short-term gain was there, will be taxable at normal rates. Yes or no? But if their period of holding is more than 12 months, so they are your long-term capital asset. And in the case of these bonds, when they were long-term assets, no, indexation was also available. Okay, for only these bonds. Okay, no? And after taking the indexation, whatever long-term gain was there was taxable under section 112 at LTCG rates. Understanding? Now this used to happen if they were transferred prior to 23rd July. But if they transferred on or after 23rd July 2000, so you will cover them also in 50AA, no? You will cover them also in 50AA? No, don't cover them 50AA. They will be still, you will go check the period of holding. Earlier, how much period of holding you used to check? 12 months. Now also 12 months, because listed securities, earlier also it was 12 months, and on or after 23rd July also it is 12 months. So period of holding less than equal to, same thing, copy, paste, duplicate. Okay, no? Copy, paste. Then sir, period of holding more than 12 months. It was long term, but earlier you were getting what? Indexation. Now that indexation will not be available. Be careful about this. Color, yellow color. So both are not same, both are different. Earlier you used to get the indexation, then index gain was taxed under 112. Now without indexation the gain will be taxable under 112. Understanding? Now next. Listed bonds or debentures other than capital index bonds and sovereign gold bonds. Yes or no? If they are transferred, prior to 23rd July 2024. What you used to do? Check the period of holding. You used to check the period of holding. How much? 12 months only. Because they are listed. Yes or no? And now also if you will transfer, you will see. So on or after 23rd July 2024. So in both the cases, the things are not different. Things have remained same. So what are you going to see? Their period of holding. If they are less than equal to 12 months. So short-term capital asset, and you will calculate short-term capital gain which was taxable at normal. Earlier also and now also. Understood? Next one. If their period of holding is more than 12 months, then they were long-term capital asset, and here indexation was not available. Earlier also not available, now also not available. And the resulting gain was long-term capital gain under section 112. Done, sir? So this is all about your bonds and debentures. I have given this entire thing in the chart. Okay. Now let's go to 50B. Very important section. One question, 10 marks in the exam. Not sure, but if it comes, one question of 10 marks straight away can be asked from this section. And we'll solve one question, we'll come to know that what type of questions are asked. Okay. So first of all, 50B talks about how will you calculate the capital gain in case of slump sale. Slump sale. Yes or no? Do you remember we did section 50? Hello? Section 50 told you how to calculate capital gain on what? Transfer of a specific asset. Which asset? Depreciable asset forming what? Part of block. Meaning if this is the asset, how you will calculate capital gain is given in section 50. That we have already seen. Then section 50A, which also told me that how to calculate capital gain on transfer of depreciable asset only. Depreciable asset which is not forming part of, then this asset is individual asset on which the depreciation is claimed under section 32(1)(1) on what basis? SLM basis. Yes or no? So for this type of asset, depreciable asset not forming part of block, how the capital gain will be calculated? That was given in 50A. Now next section we saw, section 50AA. This section also told you that how to calculate capital gain in case of 1, 2 and 3 assets. 1, 2 and market linked debentures, units of specified mutual fund which was acquired. on or after 1st April 23 and unlisted bonds or debenture which is transferred on or after 23rd July 24. So for these three assets, for 1, 2 and 3, these three assets, how will you calculate capital gain given in 50AA? Now 50B is there. Which section? 50B is telling you that how will you calculate capital gain on what? Slump sale. Now what is slump sale? That you have to understand. But once you come to know that, okay, oh, the transaction is a slump sale transaction. So in slump sale transaction, how the capital gain will be calculated? Section 50B. So first we'll have to understand that when will you call a transaction a slump sale transaction. And if you know that the given transaction is a slump sale transaction, how will you calculate the capital gain? That is given in section 50B. So all these sections which we are doing are computation of capital gain only, but in special situations. That is why special aspects. Getting my point? So in this situation, how will you calculate capital gain? For this asset, how will you calculate capital gain? Yes or no? Computation of capital gain is given. That if this happens, calculate your capital gain like this. If this happens, calculate your capital gain like this. But you have to identify these things in the question. While looking at the question, you will come to know, oh, in this question, they are talking about slump sale. So I will calculate the capital gain as prescribed in section 50B. How that capital gain will be calculated, that we are going to see. But first of all, tell me, what is slump sale? No. Slump sale is defined under section 242C. So there is a section 242C. In this section, the definition of slump sale is given. What is a slump sale? See, slump sale means this. Read. And then somebody explain. Understanding, no? Handwriting? Sure. So tell me, what is the meaning of slump sale? Explain. Very simple, it is written. You cannot say, what is slump sale? It is given, no? Slump sale means what? It means transfer. Transfer of what? One asset, two asset, or entire business. Entire business transferred for a lump sum amount, lump sum consideration, without assigning values to individual assets and liabilities. So are you giving individual values to assets and liabilities? No. Give me a lump sum amount and take my business. This is what? Slump sale. So when you transfer your business as a going concern, entire business unit, entire business undertaking or business division, whatever you want to say that. Business unit, business division, business undertaking, entire business undertaking, you are transferring. Transferring means how you are transferring? Sale? Yes, then also it is a slump sale. Exchange? Yes, then also it is a slump sale. Compulsory acquisition? Yes, then also it is a, because they are saying transfer of a business undertaking by any means. Any means meaning what? It can be transferred by way of sale also. It can be transferred by way of exchange also. It can be transferred by way of relinquishment also. It can be transferred by way of compulsory equity. Any means you transfer your business undertaking. So right now you are doing a business. Okay. You have two businesses, Unit 1 and Unit 2. In Unit 1, you are manufacturing cars. And in Unit 2, you are manufacturing computers. So you have two manufacturing businesses. Manufacturing of cars, manufacturing of computers. So one business, manufacturing of cars. Unit 1, that entire business you are transferring. Transferring how? Selling. Entire business is sold. Or entire business can be exchanged also. You give this business and against that you take another asset. Then also it is a slump sale. Getting my point? Sometimes relinquishment also. You give away your business and in return you can get something. For example, I have given my entire business to some company and from that company I told that company to issue shares to me. Make me your shareholder and take my entire business. What is that? Slump sale. So it can be by any means. It can be by sale, exchange, relinquishment, extinguishment of right, any ways. Okay, no? So first of all, do you have a business undertaking? Is it a going concern? As a going concern only, you transfer your business undertaking. When you transfer, the transfer can be by any means. Sale, exchange, relinquishment, yes or no? And if you are transferring at a lump sum consideration, lump sum. Meaning to the transferee, you are telling that give me this much amount and take my business. A lump sum amount you are charging for transferring your undertaking. But in that lump sum amount, neither you nor the transferee, none of you know that for which assets, which liabilities of the business, how much is charged. Entire business will have many assets, entire business will have many liabilities. Each asset and each liability, individual values are not assigned. Take all the assets and liabilities of my business and give me a lump sum. For this asset, give me this much. This asset, give me this much. This asset, give me this much. For this liability, reduce this much. No, 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 no. Individual values to assets and liabilities is not assigned. Okay. You are taking a lump sum. Now, in this lump sum, you don't know that for which assets you have charged, how much, and for which liability you have reduced, how much. You also don't know, and neither that transferee knows. So, for example, if I had two businesses, Unit 1 and Unit 2, car manufacturing business and computers manufacturing business, entire car manufacturing business I am selling you as a going concern. Till now, I was sitting on the table, I was sitting on the chair as a owner. I will stand up from the chair, you come and you sit on the chair as your owner. From today, you are the owner of the business. Business is going concern. But only the owner is changing. I will move out as an owner. You come and you sit as the owner. So if you wanted to start a car manufacturing business, then don't start a new car manufacturing business. I'm already having a car manufacturing business. Take this business from me and give me a lump sum. Ready to buy my business? Yes. I'm offering my business for 50 crores. Give me 50 crores and take my business. If you are ready to take the business for 50 crores, you will give 50 crores. You will take my business. And in this 50 crores, no, individual values of assets and liabilities is not known. Then this entire transaction is what? Slump sale. Will you remember this? Sure. Now read the definition once more properly. capital gain in case of slump sale. What is the meaning of slump sale? Slump sale means transfer of any business unit, division or undertaking by any means, that is sale, exchange, relinquishment, compulsory acquisition, etc. as a going concern for a lump sum consideration without assigning individual values to assets and liabilities in such transfer. So now there are few important ingredients in the transaction. So if all these things are present in the transaction, only then the transaction will be treated as slump sale. So slump sale transaction will happen for what? There has to be a business undertaking, business unit, business division. Yes or no? This business undertaking will have many assets and many liabilities. So having so many assets, so many liabilities, this business undertaking is transferred as a going concern. Okay, no? So this transfer can be by any means. Any means meaning what? Sale, exchange, relinquishment, any means. Yes or no? As a going concern. And for this transfer, a lump sum consideration is charged. Okay. This lump sum consideration is charged without assigning what? Value to individual assets and liabilities. If all these conditions are satisfied, then the transaction is a slump sale transaction. Okay. Now if you will come to know that this slump sale transaction has taken place, so in this transaction also the capital gain needs to be calculated. But you are calculating capital gain for which asset? One asset, one liability, or all the assets and liabilities taken together? So definitely you are going to calculate the capital gain for this entire business undertaking. So for you, what is a capital asset? Under section 50B, what is a capital asset? This entire business undertaking is a capital asset. And for this, you are supposed to calculate the capital gain. Now tell me, to calculate capital gain, number one, full value of, what is full value of consideration? What is the asset? This entire business is a capital asset. Yes or no? Sold, exchanged, relinquished, transfer is happening. So for that transfer, any consideration is received. What is that consideration? This is the full value of, but wait. This is not so easy to take this lump sum consideration only as full value of consideration. You are supposed to take the fair market value of this lump sum consideration, because sometimes the lump sum consideration can come in the form of asset also. Sometimes you get the value in the form of cash, money. But if business undertaking is given and in return some other asset is also coming, then so you'll have to take the market value of that asset. Okay, guys, see. So the slump sale, lump sum consideration, fair market value of the lump sum consideration. Meaning what? The whatever consideration is coming to you, you are supposed to take the fair market value of that. So two things you are supposed to make sure. Number one, the consideration which you are receiving, is it in cash? So whatever cash value is there is fair market value of consideration. Yes or no? But if some other asset is coming, then fair market value of the asset coming. So you have to take the fair market value of the lump sum consideration. Fair market value of the lump sum consideration. Yes or no? That is the money value or the value of the assets received. Now this fair market value, this is known as FMV1. This is known as FMV1. You have to take one more FMV. It is not necessary that the consideration which you are receiving will always be a correct amount of consideration which you are going to tell. Possible or not? Sometimes the consideration which you are receiving, you can also say that you have received only this much, but actually you would have received higher amount. So there has to be a benchmark. So you'll have to calculate one more FMV, FMV2. FMV, what is FMV2? FMV2 is the fair market value of the assets of that business undertaking which you are transferring. So the business undertaking which you are transferring, yes or no? So along with this business undertaking, whatever assets are going, whatever liabilities are going, yes or no? So you have to take the fair market value of assets and liabilities. Because for example, if you have transferred your car manufacturing business, unit 1. So unit 1 will go. So all the assets and unit 1 and liabilities of unit 1 will go. So what was the fair market value of that net assets of that undertaking? For example, the entire undertaking had a value of assets and liabilities amounting to 80 crores. How much? And you are charging how much? 50 crores. Trying to fool us. If that entire business only, the assets and liabilities, net assets of that business which you are transferring, the fair market value of that only is 80 crores, then how can we even trust you that you are charging only 50 crores? There is something wrong. You are trying to hide something from us. You might have received some extra money, but you are saying that you have received only. Bloody, how can we even imagine that the value of this business assets and liabilities is what? 80. You are going to receive only 50 for that. As a businessman, as an individual, as an assessee, will you ever receive less than the market value, fair market value of those assets and liabilities which are getting transferred? No. So if you are showing a lump sum consideration less than that also, how can we trust you? Meaning in that case, the fair market value of the lump sum consideration will not be treated as your full value of consideration. We will treat the fair market value of the assets getting transferred as your full value of consideration. So you have to find out two fair market values. Number one, fair market value of the consideration which you are receiving. Number two, fair market value of the asset which is getting transferred. Meaning the business undertaking which is getting transferred. So FMV1, FMV2, whichever is higher will be treated as full value of consideration. So first, sir, tell me, this entire business undertaking, entire business unit or business division or business undertaking, this is treated as your capital asset. Because what are you transferring? This business undertaking only. So we are going to calculate your capital gain on transfer of this business undertaking. So this is your capital asset. So for the transfer of this capital asset, what are you receiving as a full value of consideration? Tell me. You are receiving the lump sum amount, no? So the consideration which you are receiving for transfer of your business undertaking, the consideration which you are receiving for transfer of your business undertaking, fair market value of that consideration. Fair market value of that consideration. That is your FMV2, which I have written here. Okay, no? So FMV2 is nothing but fair market value of the consideration, whether monetary as well as non-monetary consideration, received or receivable on what? Slump sale. So consideration received or receivable, the fair market value of that. Okay? That is FMV2. What is FMV1? Fair market value of the assets transferred by way of slump sale as on the date of such sale, determined as per rules. So how will you determine this fair market value? It is determined based on the rules. So rules will tell you that the asset which is getting transferred, meaning the entire business undertaking which is getting transferred, how to calculate the fair market value of that business undertaking. What assets are to be taken, what liabilities are to be taken, okay, and what value will be considered as a fair market value. So whatever assets which are getting transferred as a part of your business undertaking, whatever assets which are getting transferred as a part of your business undertaking, the fair market value of those assets. The fair market value of, we cannot even imagine that you can charge less than this amount. So if you have charged more than this amount, then this amount will be your full value of consideration. But if you have charged less than this amount, then this will not be your full value of consideration. This will be your full value of consideration. Getting my point? So FMV1 or FMV2, whichever is higher, will be your full value of consideration. Now how will you calculate this fair market value one? This is FMV of the assets which are getting transferred as a part of your business undertaking in slump sale. Yes or no? How will you calculate them? Which assets you are going to take? What will be the value of those assets to calculate this FMV1? Given in rules, income tax rules. But don't worry, this value will be given in the question. You are not supposed to apply the rules. You are not supposed to determine this FMV. This FMV will be given in the question. At intermediate level, they don't ask you. But when you will go to final, no, you learn how to determine this fair market value as per rules. Understanding? So separate rule is made. And as per that rule, this fair market value will be determined. Simple. FMV of the consideration. FMV of the consideration received, FMV of the assets transferred as a part of business undertaking. Yes or no? FMV1, FMV2, whichever is higher, higher of A and B will be treated as your full value of consideration of this capital asset. Yes or no? Now this capital asset, full value of consideration you got, minus what? Transfer expense. So any expenses incurred as a transfer expense at the time of slump sale, that you can reduce, minus transfer expense. Yes or no? You will get net consideration. Now from net consideration, what are you going to reduce? So is it your capital asset? What will be the cost of acquisition? For this capital asset, you got full value of consideration. So for this capital asset, what will be the cost of acquisition? The cost of acquisition of this capital asset, your entire business undertaking is transferred. So capital gain for this business undertaking you are calculating. So what is the full value of consideration of this business undertaking? FMV1, FMV2, whichever is higher, minus transfer expense. You will get net consideration. So what will be the cost of acquisition of this entire business undertaking which you are supposed to reduce now? Tell me. Cost of acquisition will be nothing but net worth. Will be nothing but net worth of that business undertaking will be deemed to be the cost of acquisition. So what is net worth, sir? What is net worth? Do you know how to calculate net worth? Yes. If you don't know, go to village, do farming. CA is not your cup of tea. At intermediate level, you should be knowing how to calculate net worth. You must have done in accounts also. You must have done in FM also. Yes or no? How to calculate fair market value? Sorry, how to calculate the net worth? You take the assets of the business minus the outsider's liability. Whatever remains is net worth. All the assets and all the outside liabilities, whatever remains will be net worth. Two things are there, no? Asset side, liability side. All the assets minus outside liabilities. So whatever remains is your net worth. Understood? So take the assets of that business undertaking minus the outside liabilities of that business undertaking. You will get net worth, and that net worth will be your cost of acquisition. Reduce that. But when you will take the net worth, no, net worth has to be calculated based on the balance sheet, no? Balance sheet of which year? 500 years back. Or balance sheet immediately preceding to slum sale. So there will be a balance sheet which has to be made immediately preceding to slum sale. As per that balance sheet, this net worth, as per the latest balance sheet, this net worth has to be calculated. Now from that balance sheet, will you take the values of the assets minus the values of? So balance sheet value of liabilities you are going to take. Balance sheet values means book values. Balance sheet values means, so all the outside liabilities, whatever value is there in the balance sheet will be reduced. So outside liabilities, which values will be taken? Book values. Book values means the value appearing in the balance sheet. Same value you are going to take. Okay, no? But asset side value will come. Asset side when you will come, be careful. On the asset side, depreciable assets will be there. Hello? Don't take their book value. For the income tax purpose, for 50B, when you will calculate net worth, to calculate the net worth for 50B, what did I say? To calculate the net worth for section 50B, assets are taken. But if the assets are depreciable assets, if the assets are, you will not take the balance sheet value of those assets. No balance sheet value. Because balance sheet value is nothing but the cost of those assets which you have shown in the balance sheet. Don't you think out of that cost, some cost is already claimed by you under the head PGBP in the form of depreciation? Sir, it was not shown at cost, it was shown as WDV. But bloody the WDV which you have shown against that asset, that WDV is not calculated as per income tax. That is calculated as per books of accounts, accounting rule. Different method of depreciation, different rate of depreciation. Yes or no? So that value is not the correct value of those depreciable assets for income tax purpose. So whenever you are going to calculate the net worth for 50B, all the depreciable asset, whatever balance sheet value is given, ignore that. What are you going to take? The WDV of those depreciable assets which is available for the purpose of Income Tax Act. Meaning the cost of those assets which you had actually incurred, out of that whatever cost which is already allowed in the earlier years in the form of depreciation under PGBP head, and whatever WDV which is remaining for income tax purpose is the remaining cost of these assets which could be allowed under Income Tax Act. Because out of the total cost of these assets under the PGBP head, some cost we have already allowed in the form of depreciation. Now whatever remains is WDV. Remaining cost can only be taken for these assets. So your book value might not be equal to this amount, can be a different amount. Yes or no? So that book value we cannot take. For depreciable assets, we will take which value? Only the WDV as per Income Tax Act. So you will have to calculate this WDV. If this WDV is not given, you will have to calculate this WDV as per Income Tax Act. Sometimes this value will be given, directly take this value. But sometimes this value is not given. So you will have to first calculate this value. So, sir, which assets you are transferring? Which asset you are transferring, sir? Entire business undertaking. Entire business. So you are calculating capital gain on transfer of entire business undertaking under slum sale. Yes or no? What will be the full value of consideration? FMV1, FMV2, whichever is higher. What is FMV1? Fair market value of all the assets, all the capital assets transferred under slum sale. Yes or no? You will compare that with fair market value of the lump sum consideration received, whether monetary or non-monetary, all taken together, yes or no? FMV1, FMV2, whichever is higher is the full value of consideration of this entire business undertaking minus transfer expense. You will get net consideration minus what? Cost of acquisition. This cost of acquisition of this business undertaking will be what? Net worth. So to calculate net worth, you will take assets of this business undertaking minus outside liabilities of this business undertaking. Outside liabilities from the balance sheet. Balance sheet value is given. Reduce that. But that outside liabilities, book value, balance sheet value, you will reduce from the total value of assets. Yes or no? Total value of assets minus outside liabilities. Okay. So what will be the total value of assets? So you will have to check the balance sheet. Balance sheet of the business undertaking which is getting transferred under slump sale. Balance sheet immediately preceding to slump sale. From that balance sheet you are going to take book values. So book value of all assets you are supposed to take. But wait, if there is a depreciable asset, if there is a, don't take the book value of those assets. You will take WDV of those assets. WDV calculated in books of accounts. Then WDV as per income tax. If some asset is there in the balance sheet whose entire cost was allowed under section 35 because that asset was used for scientific research. So don't you think entire cost of that asset was already allowed under PGBP head? Some asset is appearing in the balance sheet whose entire cost we allowed under section 35AD. Because the business undertaking was doing what? Specified business, and for specified business this asset was acquired. So its entire cost we allowed as deduction under PGBP head, under section 35A. So for that asset, whatever value appearing in the balance sheet, no, that is that entire value we have already allowed under PGBP head, under section 35AD, and if that value will also be taken to calculate this net worth, one amount will be calculated, will be taken as a deduction twice. So if in your balance sheet, if some asset is appearing whose entire cost was already allowed under PGBP head, under section 35, 35AD, etc., ignore the book value of that asset also, take nil value for that asset. Take which value? Why? Because the entire cost of that asset is already allowed as a deduction under PGBP head in the form of capital expenditure on scientific research, in the form of capital expenditure on specified business. Yes or no? So if entire cost we have allowed and that cost only is appearing in the balance sheet, will you take that cost again for the calculation of net worth? No, ignore that cost, take the value nil. So depreciable asset which value? WDV for income tax purpose. Yes or no? Second, assets whose cost was already allowed under the PGBP head, under section 35, 35D, etc. Then take the book value, ignore the book value, take nil. And goodwill is appearing in the balance sheet. Can you write goodwill in your balance sheet? Goodwill is your asset, no? Intangible asset. So will you show your goodwill in the balance sheet? Hello? Sometimes the goodwill is self-valued and sometimes the goodwill is purchased. See, if it was purchased then there is no problem, but if the goodwill was self-valued means what? You yourself have determined the value of your goodwill and shown that value in your balance sheet. The value which you have shown in the balance sheet against that goodwill is nothing but the accounting value of the goodwill. That value you just have calculated to be shown in your balance sheet. That somebody comes to buy your business, you can charge this much amount as your goodwill. Understanding? So what happens? Whenever the business is acquired by someone, the businessman will always value his goodwill by applying the accounting principles, valuation of goodwill. So goodwill will be valued And that value of the goodwill, which is accounting value of the goodwill, which is determined, will also be shown in the balance sheet. Now tell me, in the balance sheet the goodwill is written and against that goodwill a value is written. That value, is it your real expense or just an accounting value? So if that value you have calculated by applying the accounting principle, that amount is not actually spent by you to acquire this goodwill, why would we allow that value to be taken as your part of net worth? Take the value of that goodwill also as nil. Understanding? Because that amount, if we allow you to take as a part of net worth, what will happen before slump sale? Definitely you are going to value your goodwill. And that value of your goodwill, you will try to determine as much as you can so that you can show that value as a part of your net worth. Your net worth will increase, your cost will increase, you will reduce your capital gains. So more cost of acquisition will reduce the capital gain, no? Meaning more net worth will reduce your capital gain, no? More net worth will be there if value of the assets are increased. So to increase the value of assets, what are you doing? You are valuing your goodwill on yourself and writing the value of that goodwill in your balance sheet. Bloody tell me, in the balance sheet, whatever value you are showing against the goodwill, have you actually spent that amount out of your pocket? Is it your actual expenditure to acquire that goodwill? No, it is just an accounting value which you have calculated and shown in your balance sheet. So whenever a goodwill, which goodwill? Self-valued goodwill is given in the balance sheet, its balance sheet value will not be taken, its value will be taken as nil to calculate your net worth. Understanding? But if the goodwill was actually purchased, but it was purchased prior to 1st April 2020, then its WDV as on 31st March 20 will be taken. And if the goodwill was purchased on or after 1st April 2020, then its actual cost will be taken. And I've already done this discussion at least 2 times now. Once under the head PGBP also I have done, and second time this same discussion I have done in 55(2)(a), intangibles. If the goodwill was purchased for the purpose of your business or profession prior to 1st April 2020, some cost of that goodwill was already allowed as a depreciation till 31st March 2020. So depreciation on that goodwill which you have claimed up to 31st March 2020, reduce that depreciation out of the cost. Whatever cost remains is nothing but WDV as on 31st March 2020. That is the remaining cost of that goodwill will now be allowed under capital gains. So for the purpose of capital gains, to calculate this net worth also, this WDV will be taken. Understanding? WDV as on 31st March 2020. See, the book value of the goodwill acquired will not be taken. For acquired goodwill, either this value will be taken or actual cost will be taken. Either the WDV as on 31st March 20 will be taken or the actual cost will be taken. Actual cost will be taken if the goodwill was acquired on or after 1st April 20. Because with effect from 1st April 20, there is no depreciation available on goodwill. So entire actual cost of that goodwill which was not allowed under the head PGBP in the form of depreciation will now be considered under the head capital gains to calculate this net worth also. Understanding? Out of the actual cost, whatever cost which we have already allowed under the head PGBP till 31st March 2020, reduce that amount, and whatever cost which is remaining as on 31st March 2020 in the form of WDV, take that remaining cost under the head capital gain to calculate this net worth also. Understood? For all other assets you are going to take balance sheet values, book values. So first of all tell me, are you going to calculate the net worth? How are you going to calculate the net worth? Total assets minus the outside liabilities. So total assets, depreciable asset, balance sheet value, ignore. You are going to take WDV for income tax purpose. Yes or no? Assets whose cost was already allowed under PGBP head, under section 35 AD also. Book value of that asset, ignore. Take nil. Yes or no? Goodwill, self-valued, book value is given, ignore, take nil. Goodwill, acquired, book value is given, ignore. WDV as on 31st March 20 or actual cost as the case may be. Depends that when the goodwill was acquired. Yes or no? All other assets. Whatever book value is there, take that book value. Cash balance, bank balance, debtors, bills receivable, yes or no? All the other assets, stock, etc., all the other assets, take the book value. No problem for that. But wait, land is there. Can you show the land in your balance sheet? Yes or no? Land is a depreciable asset, no? So this is not a depreciable asset. Land is an asset whose cost is allowed under section 35 and 35AD, no? Specifically disallowed. For scientific research, any capital expenditure other than land. For specified business, any capital expenditure other than cost of land, goodwill and financial instruments. Yes or no? So land is not an asset whose cost was allowed under PGBP, under section 35, 35AD, etc. Yes or no? Land is a goodwill. So land will be covered by. So you are supposed to take the book value of the land. But wait, take the book value of the land, take the book value of all the other assets, no problem. But if you are taking the book value of any asset including the land, remember, if that book value unnecessarily you have manipulated by doing revaluation, you must have done revaluation also, no? Earlier the value of the land was only 10 lakhs. Hello? Automatically the value of your land became 50 lakhs in your balance sheet. Why? To do the upward revaluation. So what you did? Land account debit to revaluation reserve. You added 40 lakhs in the value of land and you are showing 40 lakh revaluation reserve on your liability side. That way you have increased the book value of the land. So can I say book value of the land is how much? 50 lakhs. But this includes revaluation of 40 lakhs, which is appearing in liability side, revaluation reserve. Tell me, what is the real value of the land? 50 or only 10? Then why are you showing 50? You are doing upward revaluation so that the book values are increased. The more book value, the more net worth. More net worth means more cost and less capital gains. To do that thing, you can revalue this. You can manipulate your book values like that. Yes or no? So any revaluation in this book values, what did I say? For all other assets, you are supposed to take book values. We are not denying. Take the book values of all other assets. Yes or no? But in that book value, if you have given the effect of revaluation, first you will have to ignore the effect of revaluation out of this book value. So from that book value, adjust the revaluation. So how much was the revaluation done for land? 40 lakhs, no? So what is the value of the land? 50. What is the value of land? 50. And what is the revaluation which you have done in land? Ignore that revaluation from the book value. How much value now remains? That was the actual cost on the land which you had incurred. If you would have sold the land separately, we would have allowed you cost of 10 lakh only, no? Why are you taking 50 lakhs now? Take 10 lakhs only. And that 50 lakhs which you are showing, that shows what? 40 lakh rupees of revaluation only, which is not your real expense. It is just an accounting entry increasing the book value of the asset. So if that is not your real expense, why do we allow you that amount? And if we start giving you that amount also, then for all the assets for which the book value has to be taken, the values of all those assets will be inflated unnecessary by doing the revaluation and all. Getting my point? So for all the other assets where you are supposed to take what? Book value. If in this book value there is an effect of revaluation, from that book value you have to ignore the effect of this revaluation. Meaning you have to adjust the effect of this revaluation and whatever correct book value should be there, that book value you are supposed to take. Understanding or not? So revaluation effect to be eliminated, meaning adjusted from this book value of all other assets. So if any revaluation is done, ignore that effect of revaluation. Yes or no? Now, so tell me, did you get the full value of consideration? Yes. Minus transfer expense. You will get net consideration. Minus what? Cost of acquisition. Did you get cost of acquisition also? You will get capital gain. But that capital gain will be short term or long term? Depends that your capital asset, what is the period of holding of your capital asset? For 50B, what is your capital asset? One asset or entire business undertaking? So you are calculating the capital gain for the entire business undertaking, no? This is your capital asset, no? What will be the period of holding? From where to where you will see this period of holding? Simple. The date on which the business is started. Period of holding will start from the date on which the business is started till the date of slump sale. That is the period of holding. Common sense. If the capital asset is this business undertaking, guys, if the capital asset is this business undertaking, you are calculating the capital gain for this business undertaking. So what will be the period of holding of this business undertaking? Common sense. The date on which the business was started. Business undertaking was started. From that date, the period of holding will begin. And it will end on? This will end on the date of slump sale. Yes or no? That is the period of holding. Should be how much? You will check 12 months. 12 months you check only for 4 assets. Listed securities, units of equity oriented mutual funds, units of UTI and zero coupon bonds. For these 4 assets only you check 12 months. For all the other assets you check, don't check 24 months. Here it will be 36 months only. Here it will be, earlier also it was 36, now also it is 36. Pay attention, huh? Now whatever I am going to tell you is important. See, there is section 242A, which defines what? Short-term capital asset. There is one section which defines short-term capital asset. And right now we are doing a section 50B. Yes or no? 50B talks about slump sale. Yes or no? Both the sections are same or different? Different sections, no? One is the definition of capital asset, short-term capital asset. In another section, they are telling you on slump sale how the capital gain will be calculated. Done, sir? Sure? Now pay attention. This section says that what if the period of holding of your capital asset is up to 36 months, then the capital asset is a short-term capital asset. Yes or no? So period of holding of capital asset. Which capital asset? All capital assets. But if period of holding of core capital asset is less than equal to 12 months, then that capital asset will be treated as short-term capital asset. If period of holding of 2 capital assets less than equal to 24 months, then the capital asset is a short-term capital asset. This was okay. Now then amendment came. Amendment came here. Amendment came here. That for all those assets for which the period of holding checked is 36 months. Now that 36 months will not be checked. It will be 24 months. So 24 months instead of 36 months. You have to check. Yes or no? That amendment came in 242A. 242A. Meaning for all the capital assets whose period of holding you used to check how much. Now you are going to check 24 months, less than equal to 24 months. On or after 23rd July 24. So these 4 assets are still 12 months. These 2 assets are still 24 months. Yes or no? But the assets for which you used to check, how much? 36 months. Other than these 4, other than these 2, all other assets for which you are checking, how many months? 36 months. For those assets, now you are going to check 24 months. Amendment came here. Separate section. Done? Done? Now let's go to 50B. What 50B says? How will you calculate your capital gain? Capital gain on what? Slump sale. Capital gain on slump sale. Just a second. So tell me, how will you calculate your capital gain on slump sale? Guys, you tell me. Number 1, first of all, entire business undertaking will be considered as capital asset. Okay, very good. Now this my entire business undertaking, which is transferred as a going concern for a lump sum consideration without assigning individual values to any assets and liabilities. Yes or no? By any means, if it is transferred, it is a slump sale transaction. In this slump sale transaction, whatever is my business undertaking, which is my capital asset, I am calculating the capital gain for entire business undertaking. Full value of consideration, FMV1, FMV2, whichever is higher, minus transfer expense, I will get net consideration minus cost of acquisition, which is nothing but net worth. Total assets minus liabilities, outside liabilities, net worth, and this net worth will be reduced, then I will get the capital gain. 50B says that this capital gain, 50B says that this capital gain will be short term if the period of holding of the undertaking is 36 months or less. So in section 50B only they have mentioned that the gain will be short-term gain if the period of holding is 36 months or less. So your 50B says, 50B only has given that on slump sale, whatever capital gain is arising, that capital gain will be short-term capital gain or they will be long-term capital gain if the period of holding of the business undertaking is up to 36 months or period of holding is more than 36 months. Yes or no? This period of holding should be 36 months or less. Then whatever capital gain arising on slump sale will be short-term gain. This is mentioned in 50B itself. If the period of holding of the business undertaking is more than 36 months, then whatever gain will come on slump sale will be long-term capital. This is mentioned in 50B only. And my dear friends, there is no amendment which has taken place over here. Amendment has taken place only in 242A. For all assets where you used to check 36 months, now you will check 24 months. There the amendment has taken place. But that same type of amendment, they have either deliberately not brought under this section or they have forgotten. Any of the thing is possible. Because under 50B specifically, this word is mentioned that period of holding 36 months or less, then the resulting gain will be short term. If the period of holding of the business undertaking is more than 36 months, then the gain will be long term gain. And here the 36 months, the period of holding which is mentioned in 50B, this is not changed. So this is still, you have to check 36 months over here. Understanding? Please, by mistake, don't take this 24 months. Yes, sir, you only said that all 36 months has now become, no, not this 36. Other 36 has become 24. This 36 still remains 36. Understanding? So what if the period of holding is more than 36 months? Long-term gain. The gain will be taxable under 112. Yes or no? And what if the period of holding is less than or equal to 36 months? Short-term gain. The gain will be taxable at normal rates. See, earlier also there was no indexation available. Right now forget about indexation. If the slump sale taken place prior to 23rd July, then also there was no indexation available, and right now also there is no indexation. If the slump sale is taking place on or after 23rd July 24, forget about the indexation, because indexation is not available in case of any assets with effect from 23 July 2024. Will you remember this? Sure, sir. Now the gain which you have calculated, either short term or long term, depending on the period of holding of that business undertaking, when this gain will be taxable? The year in which the business undertaking is transferred under slump sale. So the year of slump sale, the gain will be taxable. Will you remember this? Entire 50B is done. Is it easy or difficult? Easy, no? Now see, if this entire section comes, no, question from this section, confirm if a question is asked on this section, no, it will be for minimum 8 to 10 marks. Minimum. And if the question is asked on this section, no, trust me on this, it gives you cash marks. So easy question. You just have to identify the FMV1, FMV2, whichever is higher, will be full value of consideration minus transfer expense. You will get net consideration. Simple, you have to calculate net worth. To calculate net worth, all the assets minus liabilities, outside liabilities, balance sheet value. Assets, depreciable asset, WDV for income tax purpose. Assets whose cost was already allowed under 35 AD, nil. Goodwill self-valued, nil. Goodwill acquired prior to 1st April 2020. Then WDV as on 31st March 20. Yes or no? Acquired on or after 1st April 2020. Then actual cost. Yes or no? Any other assets? Book value. But in that book value, if revaluation is there, you will have to eliminate the effect of revaluation. That's it, simple. And now this entire thing they will frame in the question, and they will try to, make the language a little bit difficult for you. So let's see 1 or 2 questions on that. Yes or no? But we will take a small break, and after the break we are going to start the questions. Okay, no? So take a break, 40 minutes.